The secret strategy used by the richest people in the world to build lifelong wealth and generational wealth is pretty simple, but it's very, very powerful. Now, using this strategy, anyone can use this to build more wealth faster than anything else that you can do, and you can enjoy it tax-free and pass it down to your future generations. Now, in this video, I'm going to explain how the strategy works. It can work on any asset class. I'm going to explain how you can implement this. I'm going to break it down into the numbers and the math so you can get an idea of exactly how this can work for you, and I'm going to show you exactly what you could expect. I'm even going to give you some predictions of where I think this can go. Of course, this is the same strategy that's used by the world's richest families, and it can work for you too. So let's go. All right, now real quick before we dig in, if you're new to this channel, my name is Mark Moss, and I make these videos because I want to change the way you think about money. Because almost everything that you've learned is wrong, and if you can change the way you think about this, then you can see things differently, and then you can have more freedom, more options for your life, your family, your future. So if you like these topics and want to help me get them to more people, I'm trying to wake up the sleeping lions here. Just take one quick second, click on that like button so the algorithm sends it out to more people. And if you're not already subscribed, hit that subscribe button and the bell notification. All right, now one more thing real quick. As investors, we're looking for asymmetric opportunities, more upside than downside. We get asymmetric opportunities by having asymmetric information that most people don't have. And so I've created a newsletter called the Asymmetric Edge. It's free. I send it out to you twice a week. You can find it linked in the description of this video. Again, it's a free newsletter that I send out to your inbox twice a week to give you the asymmetric information so you can get the asymmetric gains. Of course, that's the asymmetric edge. All right, let's go ahead and jump into this. We are going to show you how the strategy that the rich use to build wealth without paying taxes and pass it down to generations is pretty simple to use and how you can do it. So let's go. We are going to talk about a very simple yet powerful strategy. And so a lot of times people in life want this to be some big secret mystery, but if I can figure out the mystery, then it's easy. The reality is that most things in life are actually kind of simple, but they're hard to do. Case in point, everybody wants the secret to losing weight. If I could just get this new device or this new technique or this new workout, I can magically lose weight, when the reality is it's pretty simple. You just consume less calories than you burn. Pretty simple. And so this is a very simple yet powerful strategy we're going to dig into. And really what it comes down to as investors, as trying to build up wealth, lifelong wealth, pass down wealth to generations, the key is that you buy assets and then you never sell them. I mean, it sounds pretty easy, right? But it's really it's the strategy that you need to learn. And by doing this, by never selling assets, you can then leverage them to control multiple assets with the same dollar. I've talked about this in a few other videos, but this is a little bit different. But basically trying to control multiple assets with one single dollar. And by doing that, you get an infinite return. If I can get a return, an ROI on this asset, get money out into the next asset, that's an infinite return, right? Because it's money that I'm already making. Like I said, I've called this the velocity of money, but this is gonna be a little bit different. So if you've watched those velocity of money videos, I know you've probably liked them. This one's gonna be a new twist, as we call it. But you know, a couple things that I just want to talk about real quick is that, as you can see from this article on Bigger Pockets, they said that you should never sell off your real estate portfolio. And so again, this is the strategy that the rich use. They buy assets and they never sell them. Of course, there's more to it. We're going to break that down and show you how you can do it. But a couple things here. You can see that investment properties, when you sell, you have a bunch of costs, right? So this is one big reason why you don't want to do that. You have commissions, solicitor costs, and then of course the big one, taxes. Taxes on capital gains that have to be paid. And so as your investment property increases in value, you can release equity by remortgaging your investment and property wealth. And so that's how the rich do it. And then the general rule about selling investment property is to never sell, right? Never sell. But that's easier said than done unless you have this perfect strategy. All right, now you really want to do this on assets that we consider trophy assets. Now you might have heard that saying before. Basically, it's one-of-a-kind assets. What it really is, rare and in demand. So it's scarce assets. So think about, you know, some of the best real estate in the world. Like I'm a surfer, so like land on a pristine or like a world famous surf break, for example. There's only a couple houses that can be on that beach. It's very rare, it's very scarce, and people want it. This could be iconic landmarks. It could be things like that. Of course, it could be fine art, collectors, cars, collectibles, things like that. But they're world-class items. Again, it could be real estate, it could be collectibles, it could be a lot of things. The key being that they're rare and in demand. Of course, just because they're rare, if nobody wants them, doesn't really matter. But you can see that especially as money continues to come out sloshing around, that investors are scrambling to get these scarce assets. That's what's really going up, the scarce assets. So when it comes to real estate, which is an easy example, we're not going to talk about real estate in this video, but using it as an analogy, when you look at land in middle America that doesn't really have any main features about it, a lot of it is there's not a lot of demand for that. Versus if you go to New York City or Miami Beach, for example, that is scarce assets. And so you can see that the trophy assets are in short supply. There's way too much money chasing a very small amount of trophy assets. And for a little bit more on what trophy assets are, basically, like I said, they're rare and in high demand. Of course, we just talked about that. But the thing is, investing in trophy assets is a guarantee, key piece, that your capital will not be eroded or depreciated. And so the point is that your dollars are like a melting ice cube and they're losing value. Every time the Federal Reserve prints one more dollar, the dollars that you have and the future dollars you're going to earn will buy less and less and less. And so investing in trophy assets is a guarantee that your capital will not be eroded, meaning that inflation won't steal the wealth right out. So that's why trophy assets, we can see that it's, like I said, commonplace in real estate transactions, but of course there's other types of trophy assets. They could be media properties, so that could be like the Washington Post, Boston Globe, things like that, iconic things. It could also be sports franchises. We've seen sports franchises, football teams, baseball teams, basketball teams going up at an astronomical level, a crazy, crazy level. Collectors' cars, I have a friend that collects cars and he bought some for $25,000, $50,000. Now some of them are worth $1 million, $2 million on some of these. Natural resources, with some mines and reserves being categorized as trophy assets. So certain mines, gold mines, etc., can be considered trophy assets. But the key thing is, like I said, they're unique and they're rare. Also, they kind of have some name recognition. So a lot of people know what they are. That way there's a lot of demand. But the thing is that we have a new invention, and this is of course what we're talking about, and it is the most scarce asset in the world. Now, I guess I can't really say that, not the most scarce asset, like the Mona Lisa painting. I suppose there's only one Mona Lisa, but this is an asset class. All right, so it's the most scarce asset. We'll talk about that. And so Bitcoin, of course, has 21 million hard cap, and there can never be any more. Now, there's never been a constant. And so what's important to understand about this is, in the Austrian School of Economics, Mises said that in economics, there's no such thing as a constant. And so what that means is that in everything in life, we have standard units of measure. So imagine if you're trying to build a house, but you didn't know what an inch was, or a foot was, or a pound was, or a yard was. How could you coordinate an architect to design it and the builders to build it without that standard unit? But in economics, he said that there's never been a constant because, of course, the oil supply is going up and down, the gold supply is going up and down. Of course, the supply of dollars is just keep going up. Real estate's going up and down. So you have all these things are always moving against each other. Assets are always moving. Until now. Now we have an asset that has a hard cap of 21 million, which is one of the many reasons why this is so revolutionary and what's going to really dramatically change the world. Not going to get into that. But the key thing is that it's the most scarce because, one, we know it has a hard cap of 21 million. The other thing is that just in the world, we have about 46 million millionaires. Let me show you that. But first off, so this is the Bitcoin inflation versus time. So unlike gold, gold does have a pretty low inflation rate. However, if the gold price went up, more people would go start exploring and we'd bring more gold into the world. Of course, they're talking about mining gold off of asteroids. So who knows how much gold there is in this world? We don't really know. But Bitcoin, we do. We do know that every 4 years, the supply gets cut in half. And we know exactly when the supply will get cut, and we also know at what point it stops, like I said, at 21 million. And we can look at this in stark contrast, and this is crazy. So this is the M1 money supply. This is from the Federal Reserve data. And this is the M1 money supply, and you can see this money supply tracking. So this is 1980 right here, and you can see it tracking along. Here's 2008. So 2008, you can't really see that. 2008, they print a lot of money in 2008 to save the entire world, the great financial crash. Of course, you can't even see that. That's a blip on the road. And then look where we are right here. Now, what's crazy is, like I said, 2008, you can't even see that. and look at where we are right here. But even more than that, they can't even keep track of it. Notice that this says discontinued. This series will no longer be updated. They decided that they don't even want to report this anymore because guess what? They broke the chart here. So the fact that they don't want to show us that is pretty amazing. So we have, in stark contrast, a couple things. One, we have the money supply going up faster than we could ever imagine. And not only going up faster than we can ever imagine, they don't even want to report on it anymore. Where over here, we have Bitcoin with a predictable supply schedule going down, down, down. And we can see here, so in the world, global wealth statistics, we have approximately 46 million millionaires. So do the math. 46 million millionaires in the world, 21 million Bitcoin. Now, the reality is there will probably be only about 17, 18 million Bitcoin because a lot have been lost. But let's just use the hard number of 21, fully diluted. So 46 million millionaires chasing 21 million Bitcoin. That means there's not even enough Bitcoin for all the millionaires to even own half of one. And a lot of people own a lot more than one. And so there's not even enough Bitcoin for all the millionaires to even have one. That is just an idea of how scarce it is. Okay, so it has to be scarce, but it also has to have demand, right? So just because it's scarce doesn't mean it's going to go up. So will the demand continue to go? Will we continue to have growth? Of course, the second part to the trophy asset to this equation is a scarce asset. The second part is demand. We have to make sure there's demand there. Just being scarce isn't enough. And so really we want to look at, will the growth, will the demand continue to grow? Just because the inflation schedule is going down, that makes it scarce, but will it continue to grow? So what we can see is that this is the compound annual growth rate. It's unprecedented. It's unprecedented for any other asset that we've seen pretty much in history. It's been averaging 200% per year over the last decade, or a total growth of over 5,000%. And so we can look at, there's all kinds of data, all kinds of charts that we can look at, but a couple that I thought were pretty interesting. Right here, you can see that the 10-year compounded annual growth rate. And you can see here, like I said, about 200% that it's been growing annually, compared to gold at 1.97%, not even 2%, which is not even close to keeping up with inflation. We have the S&P 500, which is what a lot of people use to try to beat inflation. It's gone up by about 11%, so not really keeping up with inflation. We have the NASDAQ, which of course are the tech stocks, and those have been the big darlings, of course, over the last decade, right? We have, you know, the FANG stocks, Facebook, Apple, Netflix, Google, etc. They're about 17%, so they're just beating inflation. They're keeping your money safe there. We have long-dated U.S. Treasuries, of course, 5%, nowhere close. Tesla, which has been, you know, one of the best performing companies, is up 63%. So Tesla's done amazing. Amazon has done 33%. So you can see that Bitcoin has completely smashed it on compounded annual growth rate. But now you might say, Mark, you might be cherry picking data. Maybe you're cherry picking data, so we can take a look at this chart. And this is looking at different periods. All right, so there's any multi-year period to today has still dwarfed every asset class. So the gold here is Bitcoin. Of course, then we have gold is the green, and we have the S&P 500 is the purple. And so you can see over the last 2 years, 3 years, 4 years, 5, 6, 7, 8, 9, 10. So any year you want, it's continued to smash all of them. All right, now a lot of people say that, well, okay, that may be true, but it's also so volatile. How can I put money in there? And what I'd say to that is a couple things. One, you just need to kind of zoom out. So one thing that we know is that yes, it's been volatile. The price goes up and down. However, the lowest point every year has been higher. Let me show you an example of this. Except for 1 year, we have the yearly lows. So in 2012, the lowest point of the year is $4, lowest point $13, $300. So 2015 was the anomaly. It actually went down right here, but then it's higher, 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 higher every single year. So if you think it's too volatile, maybe you're zoomed in too far. It's kind of like it's been tracking like this, right? So the lowest point is higher each year, but the actual price is doing this, right? So depending on where you bought it, yeah, you could be higher or lower, but each year the lowest point has continued up like this. And so that's the most important thing. But let's look at a couple of other data points here. Okay, so now I showed you that it has been the best performing asset, 200% a year, compounding, which is amazing, unprecedented. But then the next question is, can it continue, right? How long can this go on for? How long can it continue to go up at that rate? Well, let's just look at a couple things. So first off, we know that the Federal Reserve is targeting a 2% inflation rate. So what that means is that they're trying to increase the money supply, or really what they're trying to do is take away 2% of your purchasing power every single year. That's their goal. That's their stated goal. So that means that if you put $10,000 in the bank 10 years ago, today it only buys about $8,000 worth of goods. That's their goal. But the real inflation rate is actually somewhere much higher. It's probably between 15 to 20%. The problem is that it depends on what you measure, all right? And so what this means is that the Fed uses something called CPI. I've done videos on that, Consumer Price Index, and it all comes down to the way they calculate that. And they've changed it over time, over and over. And so we can take a look at a couple of those things. Now, what we can see first off, like I said, they increase the money supply, and every time they increase the money supply, it takes away the purchasing power of the dollars you have. You can see from the Mises wire here, the money supply was up 37%. So they increased the money supply by 37%. So imagine what that does to your purchasing power, right? We can see that start to trickle in. We can see right here that that 35% of all US dollars in existence were created in like the last year. 35%, so that's how much they increased it. Again, I've already showed you this chart, but I'm gonna bring it back up one more time because you can see, like I said, in 2008, you don't even see the money supply increase. Here it went up like crazy, and here they have discontinued that. But what does that really mean, right? Like I said, CPI doesn't really gauge it properly because they constantly change the way they calculate it. So if you want to know what the real rate of inflation is, don't even bother looking at CPI. So let's look at a couple other things. So there's a company called Shadow Stats, and they measure inflation kind of more like it used to be done. And they've done two ways. So there was a big change in how CPI measured inflation in the 80s, and another big change in how they measured inflation in the 90s. So if we use the 1980s based version of CPI, we're really right here, probably about 9–10%. You can see right here. So that's what they're saying that inflation is. If we look at the more updated version of the 90s, we can see that we're more right here, about 5–6% inflation. All right, but again, it all comes down to what you're measuring. So what do I mean by that? It depends on what assets you're buying, what assets that are in your basket. So here's some more baskets. So just this year in commodities, now I've been talking about as they print an unlimited amount of fake fiat currency, people are gonna buy hard, real assets, commodities. So we can see steel's up 150%, lumber's up 126%, oil's up 80%, soybeans 70%, copper 50%. We can go on down the line. We can see other prices. So these are like other stocks. Obviously, GameStop went up big, 50, 100%, but Bitcoin's up 470%. The stock market's up about 23%, and home values are up about 8%. The money supply, 24%. So as the money supply goes up, all these prices go up. Notice that? Hourly wages are up. Reported inflation, 1%. Come on, how is it 1% when all these prices went up? Of course, it's because they're not calculating them. Now, this is based off the US. If you live in other countries, it could be much, much worse. As a matter of fact, this is inflation in other countries. 1,945% in Venezuela. How can you live? 400% Zimbabwe. I mean, this is crazy. I mean, all the way down here to Libya, 26%, Brazil, 31%, Iran, 100%. And so if you live in another country, it's even much, much worse than what we've just shown. And that's one thing if it's you and I and the cost goes up 15, 20%, but what if you're a sovereign? What if you're an institution or a sovereign government that has hundreds of billions of dollars? Starts costing a lot of money. So it's hard on us. I mean, my $10,000 only buys 8,000, but what if you have 800 million? And what if you have 800 million? Then it's a much bigger story. And there's a couple big narratives here. The first thing is when you have hundreds of millions of dollars, where do you put it? You don't put it in Bank of America or Wells Fargo or JP Chase. Instead, you buy bonds. And that's a big problem. As a matter of fact, as of right now, we have approximately $16 trillion sitting in negative yielding bonds. What does that mean? So this is the amount of negative yielding debt. All right, and you can see that it's just been going up, 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 up. We're down just a little bit right here. So right about $16.5 trillion is literally worth less than zero. Literally worth less than zero. So what I mean is I give you my money, and when you pay it back, you don't give me interest. You pay me for loaning you the money, right? So it's actually negative yielding. You're not earning interest, you're paying to have someone borrow your money. And so about $16 trillion is literally worth less than zero, and it's not gonna get better. As Forbes says that 2021 is gonna be the worst year on record for the bond market. We have BlackRock, one of the largest financial institutions in the US, says that do not put your money, and they have downgraded government bonds. See that? They've downgraded government bonds. This is just February 23rd of 2021. And so the bond market is looking horrible. The government bonds have been downgraded. About $16.5 trillion of them are negative yielding. And on top of that, we have the world's debt is about $280 trillion, but it's expected to continue rising this year. We have about $300 trillion of debt. And so all of that debt has to go somewhere. The Fed is continuing to print dollars. Prices are going up sky high because the purchasing power is being robbed from them. And the debt and bond market is going up at a rapid rate, and it's paying negative yield. So where does all that money go? And that's where we can look at how high can Bitcoin ultimately go. Now, like I said, it has been going up at about 200% per year if we look at the last decade. But can it continue that? Can it keep going? Well, like I said, we have about $300 trillion of debt that's going to need to find a place to go. Could it get 5% of that? Could it get 10% of that? I think it could. Could it get, the gold market right now today is about $9 trillion. So how much of it could get from that? Now, Michael Saylor, who, if you've listened to him, he's probably one of the smartest people. He's an MIT engineer. He understands this at a high level. So this is his quote right here. And he says that Bitcoin is going to keep growing. Now, this is his words. I'm going to agree with him, and we're going to base some numbers. We're actually going to not use his aggressive numbers, but this is what he says. Bitcoin is going to keep growing. It's going to grow 200% a year until it's demonetized gold, silver, sovereign debt, bond indexes, and stock indexes. So what does that mean? It's demonetized gold. So it's taken all the value. So there's 9 trillion sitting in gold. He says it's going to take all that. He says the silver market, the sovereign debt, right? So we just talked about that. There's about $16 trillion of negative yielding debt. Why would they do that when there's an alternative? He said it's going to take bond indexes. I just showed you. BlackRock said don't buy bonds. Forbes said 2021 is going to be the worst year for bonds. It's going to take from that. And it's also going to take from stock indexes. I showed you how it completely smoked the S&P 500 and the NASDAQ. And so it's going to take value from all those areas. He says that it's going to keep going up for the next decade at the rate that's been pretty commensurate to what it's been doing for the past decade. So he says that he thinks it's going to continue to grow at about 200% a year for the next decade, just like it's done in the previous decade, because it needs to absorb all this money from these places, all right? On top of that, he didn't mention this, but I'm just going to throw this out there. On top of that, there's about $30 to $40 trillion parked in offshore bank accounts. So Bitcoin is kind of like digital gold, like a better version of gold. So it could easily get a piece of that. It's kind of like a Swiss bank account in your wallet, in your pocket, right? So instead of having my money in the banking system, I can get it outside where the government can't reach it, which is exactly why people use offshore bank accounts. There's about $30 to $40 trillion parked in that. Could it get 10, 20% of that? It certainly could. What about value parked in real estate, stocks, and corporate treasury? So I just sold a property, an apartment building I had, and I didn't buy another apartment building. It went into Bitcoin. I've opted not to buy a lot of stocks, and I bought more Bitcoin. Corporate treasuries, we see all the corporate treasuries are now starting to put it in. As a matter of fact, Kathy Wood from ARK Financial thinks that we could have as much as 10% of corporate treasuries going into Bitcoin over the next couple of years. And so we're going to see that more and more. Okay, so now that I've set the stage a little bit for you here on the growth rate, what we can expect, the future, etc. Now, what's the strategy? How do we actually buy an asset and never sell the asset? That's what we're going to talk about here. So I was just going to show you here. So This is the real stuff. So you can see here, my friend Wendy on Twitter said, my friend Mark convinced me not to sell some Bitcoin to buy my dream house. Don't sell your Bitcoin to buy your dream house. I convinced her, and I'm going to break down the math for you the same way. So of course, never sell scarce assets. So those trophy assets, they only go up in value because they're so limited. There's more people chasing them and they're very hard to get back. The value keeps going up on those types of assets. So what we want to do is, as the value goes up, instead of cashing in to get that value out, instead, we can use debt against the asset. I'm going to break that down. Now, when we do that, when we leverage debt, debt is not taxable. All right, so let me give you a house example. So in Wendy's case, for example, let's say that you had $200,000 of Bitcoin. And what you could do is you want $100,000 for a down payment on a house, for example. Now, this could be $20,000 of Bitcoin and you want a $10,000 down payment. It could be $2 million of Bitcoin and you want $1 million. You figure out the math for yourself. But let's say that you have $200,000 of Bitcoin and you want $100,000 for a down payment. Now, you have an option. The most option, what she wanted to do, was to sell $200,000 worth of Bitcoin. Now, the problem is when you sell that Bitcoin to realize that gain, you have to pay tax. Now, depending on how long you've held it and what your tax bracket is, you could pay as much as 50% tax on that, which means at the end of the day, you end up with $100K to put down. So you had 200, but you owe 50%. Now, it could be 35%. Like I said, depending on your tax bracket, how long you've held it. But let's say that you owned it for less than a year, your tax bracket's high, you're gonna pay 50%, and you're gonna end up with $100K. So you lost $200,000 of Bitcoin to end up with $100,000 to put down on a piece of property. Another option would be to take the $200K and then you borrow 50% against it, right? And then you get the $100,000, but you have $100,000 to put down on the house, and you still have the $200,000 in Bitcoin. Let me break this math down for you so you can see exactly how this works, all right? So, like I said, if we start with $100,000 in Bitcoin, I have all the math here for you. So let's break this down. So let's say, for example, that you have $100,000 worth of Bitcoin in the bank. Now, again, this could be $1,000, it could be $1 million or 10 million. You do the math in your own head. Let's say that it gains at 200%, like Michael Saylor said. Now, he says that well, obviously, we already know that it has gained 200% a year, compounded annual, for the last decade. He says it can continue to do that for the next decade, but let's not be anywhere near that aggressive. So let's say that it continues to do that this year. It's already done way more than that this year. I think it's at 300-400%. So it's already done more than that this year, but let's say that next year it slows down to 150, then it slows down to 100 for a couple years, then it goes to 50, 30, 20, 15, 15. Now remember, he said 200 all the way down, but let's not be that aggressive. So we start with $100,000 and we don't touch that, right? So let's say that you're working, you don't really need the money, and you give it 5 years. So we get to here year 5. Now, year 5, what you can do, you're sitting on about $3 million worth of Bitcoin. You could take a 5% loan to value, right? So you're borrowing $150,000 from your $3 million worth of Bitcoin. That $150,000 is tax-free. You don't pay tax on that. You didn't even sell your Bitcoin. All you did is you borrowed against it. So because it's debt, it's tax-free, and you can spend that money. You can go live on that. That can be your living expenses. So now you're living on $150,000 a year, tax-free. That's like making $300,000 a year before taxes, right? And you could use that money however you want. Now, the next year, it goes up again, it goes up 50%, and now you have 6 million, and the next year you borrow 5.5%, which is 330 grand. The 330 grand is used to pay back the 150. So you paid back the previous loan and you kept 180. So now you have more because your cost of living is going up, your money is going up. So you had 150 to live off the first year. The next year you have $180,000 tax-free to live on. It goes up, it goes by less this year. Now it goes up to 9 million. You borrow 5.8%, which is $500,000. You pay back the 330 and you keep $192,000 to live on and on and on and on. I'm not going to break down every single year, but here's the thing. At the end of year 10, hypothetically, if this worked out, you could end up sitting on $16 million of Bitcoin. That's how much you would own and control. $16 million in Bitcoin, or US dollar value of Bitcoin, I should say. purchasing power. That's a key piece. So the number of Bitcoins you own won't go up. It's just the purchasing power. So for example, if you had $100,000 in your bank account, in 10 years, you still have $100,000 in your bank account. The difference is that 100,000 buys only about $80,000 worth of goods versus, let's say you had 10 Bitcoin in your bank account. In 10 years, you still have 10 Bitcoin in your bank account. But the difference is it buys more instead of less, like the dollars. So in this hypothetical example, you'd have $16 million of US dollar valuation of Bitcoin, and you would owe about $3.8 million of debt. So you owe debt. You're $3.8 million in debt against that, which means you have a net of about $12 million, but you've been able to pull all this money out completely tax-free and live year after year. Your cost of living is going up 180, 192, 203, 221,000 per year, all tax-free, all off of your starting value of $100,000 in Bitcoin. So that's the strategy. All right, now how do you actually do it? That's the strategy, but how do you actually do this? Like if you want to do it right now. All right, so like I said, I just made the case is that you borrow against your collateral. Now, this is nothing new, all right? Just because you can do it on Bitcoin now does not mean it's anything new. It's basically asset-based lending. Now, this is, it's been done on stocks. It's been done on real estate for a really long time. It's how I've built my real estate portfolio. You can see that just looking right here, we can see that Wells Fargo, here's Wells Fargo Advisors. They offer securities-based borrowing, so that's against your stock, access the value of your investments. It doesn't have to disrupt your investment strategy. So you can access the value of your investments. This is right off Wells Fargo's website. Gives you the access to money based on the value of your securities. This is for your stocks. The advantages are access to cash when you need it, lower rates, and then look at this. Borrow between, here. Potentially avoiding capital gains taxes from selling. So you're not paying taxes from selling the stocks, you're accessing the capital. And here you can say that you can borrow between 50 to 95% of the value. So you have $100,000 in stocks, you could potentially borrow $95,000 against that. All right, so this has been going on for a really long time. That Wells Fargo offers that right now. You can see that Wall Street Journal says that these loans are big growth area, a big revenue driver. So this is something that the financial industry wants to get into more and more. We can see that in the traditional finance world, the oldest bank in the United States, Bank of New York Mellon, has revealed it will start financing Bitcoin. The oldest bank in the United States is now going to start financing Bitcoin. Allow cryptos to pass through the same financial network it is using for traditional holdings like US Treasury bonds and equities. The oldest bank in the United States is now going to start offering financing on Bitcoin. Of course, you can do it now with one of the largest financial institutions in the United States. Fidelity is offering loans against your Bitcoin. They're doing it, their institutional clients can do this, and they do it in partnership with BlockFi, which is a pretty good endorsement for BlockFi. I like to use BlockFi. They are a United States-based company, so they're fully regulated, fully transparent. They have big backers on Wall Street, VCs, etc. And I believe that's probably why Fidelity chose to work with them. Now, this is a growing area. Like I said, BNY Mellon is going to start adding it. You know, who knows? Probably Wells Fargo will start adding it at some point. But you can do it now with Fidelity through BlockFi, or you can just go directly through BlockFi. So it's pretty easy to do. You just go and say, here's how much money I want to borrow. You can look at how much you have to put up. The more you put up as collateral, the different your rate will be. So different loan to values are going to have different rates. They say about as low as 4.5%. So that's exactly how you can do it. Now, let's just say that, of course, the future's unknown. I don't have a crystal ball. If you followed me for any time, you know that I always say that if I just had a crystal ball, things would be so much easier, but I don't. So the future's unknown. Now, these projections could do much better than what I've said. These could do much worse than what I've said. Like, we don't know. We don't know the future. But when you look at the amount of money that's being printed, and you look at the way the prices are rising, you look at the debt levels going up, the negative interest yield, and how Bitcoin continues to grow, it only makes sense that this future will continue to out that way. Now, like I said, Michael Saylor says that he sees it continuing 200% for the next decade. My projections are way less aggressive, but yet they still look pretty unbelievable. But like I said, we don't know, right? But what's the upside and the downside to this? All right, so we always want to, we want to hope for the best, but we want to plan for the worst. In investing, risk management is always number one. Warren Buffett says the number one rule to investing is to never lose money. And so we really always want to optimize for the downside. So what's the downside to this? So I have the $100,000 in Bitcoin. I decide not to sell it for my house. I borrow against it, right? Well, I borrowed against it. I still have the Bitcoin, and now I have the house. Let's say that the price of Bitcoin drops. Okay, well, the price of Bitcoin drops, but I still have my house, right? So you still have something out of it. What's the worst that can happen? Let's say that you borrowed 25%. In my example, I was borrowing 5%. So Bitcoin would basically have to go to zero for you to default on that loan. So what's the worst that can happen? What is the downside? But we do know that if you sell it to pay your taxes, we know the worst. Right off the bat, you're gonna lose 35 to 50%. That's pretty bad. That's guaranteed. On top of it, you don't have the asset anymore for any upside. So you've lost all that opportunity cost of future growth, and you're paying 35 to 50% right off the bat. I would rather roll the dice and bet that it doesn't go down by more than 50% than give up 50% today and still hang on to the assets. But of course, like all markets, place your bets accordingly. So what does that mean? So I can already see my comments filling up down below telling me that this is ridiculous, this will never work, Bitcoin's going to zero. That's fine. We're in a free market and you can put your money where your mouth is. You can bet accordingly. I believe that it's going to go up, and that's where my money's sitting. Of course, not 100%. You don't have to put 100%. You can put 1%. You could put 5% on it, all right? But I have placed my bets, and you can place your bets accordingly. So let me know what you think in the comments down below. Do you think that this type of a strategy can help you now or in the future? Of course, as always, give me a thumbs up on this video if you like it. You know I'm working hard. It takes me a long time to put these videos out there, but leave me a comment down below. Also, ask your questions about this specifically. I'm answering these questions on my other channel, the Market Disruptors channel. If I answer your question in a video, I'm gonna send you $25 in Bitcoin just for asking the question. You have to go watch it on the other channel to claim that. All right, and then one more thing, in the link in the description, you can sign up for my free new Asymmetric Edge newsletter, which I bring the latest Bitcoin news to your inbox 2 times a week. So you have the asymmetric information to get the asymmetric gains, all right? Like I said, give me a thumbs up on this video if you like it. Leave me a comment and a question. Let me know what you think. That's it. To your success. I'm out.